sell, right? So if you have to sell, that's what you're going to get for it on the open market. But if you can wait, maybe cap rates, come back down to 4 and interest rates come down again. But what I find is a lot of people, they have loan maturity issues and they have other things that are forcing them to sell, even an equity partner. So a lot of these guys have used big equity partners like, let's say, BlackRock. So BlackRock, gives me money. They want it back, in 3 or 4 years. They don't care about the market. They want it back. So then now you're negotiating with them on when to get it back. So that's not a good position to be in either, because as markets come up and go down, I have a good buddy that bought a whole bunch of stuff in Denver with a big company like that. And he's like, Kenny, our equity group wants us to sell. And he's like, the market's like not ready. It's like, we're just turning and we're about ready, to grow 2 or 3 more years is what I need. And he had to sell. So that's how managed money is. So you got to be careful,
Like you don't have a choice if they put the pressure on you.
100%. Yeah. That managed money is it's a tail wagging the dog for sure.
So overall, do you feel like the next 2-3 years, there's going to be a bunch of people defaulting, a bunch of new property coming on the market? Are you sitting on the sidelines with like dry gunpowder?
Yeah.
Like what's your viewpoint of it?
Well, I don't think everybody, I think it's going to be property specific. So, I think everybody's, I think if you've got a new construction project, you potentially are at risk because you can't finance something with a fixed rate debt that doesn't exist. It's land plus, framing and drywall and all that. Once it's done in full, then the bank has something they can wrap their head around. At that time, that's the rate. That's the loan to value at that time. So there, if somebody broke ground on something 6 months ago, you got another year and a half, right? You got to finish it. You got to deal with all these supply chain issues and all these labor issues and all that stuff. And then whatever it is, good. The good news is rents are going up. And, but so are expenses, but the rents are going up faster than expenses, which is good. So you're going to have that. Then you're going to have the people that have, that don't have fixed rate debt. That's the next problem. So, there's a reason that loan is maturing. So a variable rate, most of those rate caps, if they bought them at all, because I heard a lot of people didn't buy a rate cap. So anybody who knows what a rate cap is, a year ago, you could get something at 3%, let's say. You could put a rate cap, but it's just an insurance policy, so the rate doesn't go. A lot of people didn't buy those. At the time we bought them, they were $25,000. Now they're $1 million to renew. So in just 1 year. So, it's just an insurance policy to cap the rate. So it's just a game of math, right? So,
and that's just a fee.
Yep.
You just cut the check and lose it. Yep. And that's just part of the cost of doing business.
That's one way to hedge your rate cap. Yeah. So some people bought rate caps, some didn't. The ones that bought them, they're usually a 2 or 3 year maturity. So, let's say they started buying them 2 years ago. Some of the rate caps are going to be up this year and next year. So that's what you're going to want to watch. You're going to want to watch the big equity that wants their money back. You're going to want to watch debt that's maturing, and you're going to want to watch new construction. Those are the 3 for multifamily. And the truth is, most of these people, they didn't do anything wrong. The market, what changed was, the supply chain went crazy, and those construction and renovation costs went up. Expenses are going up, and interest rates went up. So that drove cap rates down. So the lenders are now doing 50, 55% loan to value. That's